Hi, everyone. This is Jason Barrack of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Instead of interviewing a guest, what Mo Dawood and I are going to do today is just have a discussion about the stock market, different types of asset classes, the macroeconomic situation. There's a big trade deal that's going on behind the scenes that we want our listeners made aware of, and then maybe some sectors or industries where we see value. So, Mo, with getting things going here, let's talk about the stock market going on right now. What do you see going on in the stock market?
Well, there's a lot of investors out there that has a lot of uncertainty because of what the Fed is going to do. A lot of people believe that the Fed are going to tamper down on the QE and stop their bond buying program, which we know will not happen because they know the consequences once they stop doing that. And you're already seeing the bond yield start to go up. I mean, just in a few days, the one of the bond yield went up 1% in just a matter of a few days. So you can see how powerful the Federal Reserve are. Anytime they say something like this, they can dramatically shift the stock market in a day.
Yeah, and the junk bond market almost had a heart attack, right? Because the yields on the junk bonds, I think, were below 5%, which is just insane given the credit risk and the chance people have of not getting any of their principal back. And smart money like Jim Rogers was shorting the junk bond market and making a lot of money shorting it because it was way overvalued.
Oh yeah, that's a good point. So what we see in the stock market right now is a lot of sideways action. So because the people are not sure what the Federal Reserve are going to do. Now, just think for a second. If the Federal Reserve decides to stop the QE, what would happen to the economy? That means that the interest rate would start going up for bonds, corporate bonds, junk bonds. Credit card interest rate will go up. That'll make it harder, more expensive for the government to start to borrow, to continue to finance their deficit spending, and it's also harder for people to continue to buy stuff on credit card because the interest rate on their credit card are going to go up as well.
And Mo, probably besides the consumer spending component and the government borrowing, another important thing about the interest rates is the real estate market. And this is something that we want to cover more about today, is if the interest rates were to start rapidly rising, I think you would see the real estate market potentially crash. Now, what we're seeing now in the real estate market, Mo, we're not seeing people in your and my age demographic, first-time home buyers, start a family, go and buy a house and go live in it. That's not the people that we're seeing buying houses here in the United States. We are seeing a ton of Wall Street and hedge fund money and institutional money buy interest rate and buy real estate with cheap interest rates, on lots of loans, and then rent it out like cash flow rental property income. And we're also seeing a lot of all cash deals from outside the United States come in. So people from the Middle East, people from China, people from Europe, they're coming into California, Florida, even people from Canada are buying massively, although people from Canada were normally buy like winter areas like snowbird stuff. But we're just seeing a humongous amount of flight capital come in here from, I think we were talking about this before the podcast, before we start recording, flight capital from Japan, flight capital from Europe, and now we're even starting to see massive flight capital move from China, leave their real estate bubble, leave their stock market, which is dicey, and come here to the United States' stock market and the United States' real estate.
And I'm reading an article that you sent me before this podcast from drhousingbubble.com, and a lot of Chinese buyers are in California real estate, and 70% of the purchases made by Chinese buyers are all cash purchases. So they have a lot of skin in the California real estate right now.
And they're helping Ben, they're helping the U.S. consumer, they're helping Ben out, the Bernanke.
Yeah, so we're seeing a lot of capital leave China. That's interesting because that indicates that investors in China think the real estate market in China peaks and there's no money to be made, so now they're coming to the U.S. and buying properties and real estate here now.
Yeah, Mo, and for the commodities in the trade bubble, for the real estate stuff in China, you see the lumber prices and the copper prices are down enormously. So that shows that there was humongous artificial demand for both lumber and copper in China, well, based on Chinese building. And then what you also see out of China is the trade data showing that China is just not importing nearly as many base metals. Now, China is importing massive amounts of precious metals, and we'll talk about that in the podcast. But I think, if you're a rich Chinese person, Mo, you can get your money out of the country. You can put your money into U.S. stocks. You can put your money into U.S. real estate or Canadian real estate or things like this. But if you're a middle-class Chinese person who doesn't have that much money, your options are going to be very limited. And I think a lot of that money that used to went into other few asset classes in China is now going to go into precious metals.
And we're seeing that right now. I mean, gold and silver are at very low prices or bargain prices, and we're seeing a lot of gold being imported and silver imported in India and China and maybe Japan. I don't know if Japan's buying gold and silver. I haven't read anything about that yet. I don't know about you.
After the April takedown, they bought a lot, and there were really high premiums and there were shortages, but I think there was just mostly a bottleneck there. And what happened was a lot of gold and silver started to come into Japan after the buying in April, and China had such large shortages, and the premiums were so high that the gold and silver that went into Japan, Japanese dealers started selling it into China for an even larger premium. So I don't think Japanese people are massively in the gold bull market yet, but as the yen becomes more and more trashed, and the yen I think is back over 100 against the dollar, so it's really showing like it wants to go lower because, let's face it, every single central bank in the world is devaluing their currency, or at least trying to, but Japan is devaluing their currency now faster than the U.S., faster than Europe, et cetera, et cetera.
And which is why we think, along with Kyle Bass, think that the Japan currency will be the first to collapse in the currency war.
Yes, and they have the highest debt-to-GDP ratio and a lot of other bad fundamental factors in their economy, demographics and other things for why the yen is in the most trouble in the near term.
Exactly. We touched a little bit about the Eastern country buying gold and silver. People may or may not know that India has banned gold import, and now we're seeing over $5 billion worth of gold being smuggled into India this year. So it tells you how high the demand is for the metal.
Yes, Mo, and this is a law of unintended consequences here. This is the government wants to blame all of its economic the Indian government wants to blame, and Indian central bank wants to blame all of its economic problems on gold. And that is definitely not the case. India has a lot of problems in their economy. They are growing pretty rapidly. They're growing very inefficiently, though, because they really don't allow a lot of private sector investment in their country. It's been that way since Gandhi took over and kicked the British imperialists out. He didn't like capitalism or anything like that. And it's gotten a little bit better, but not really that much. There's been obviously a lot of jobs outsourced to India, the calling centers and things like, and tech support and things like that. But there hasn't been a lot of capital investment into India in terms of building out all these different industries in India. So, and the government, of course, is blaming all of its problems, its trade deficit and the rapidly devaluing rupee, I think, against the dollar and the euro. They're blaming this on gold. But I think they're running a peg against the dollar. So they're running a dollar peg, they're printing lots of money when the U.S. prints, and they're blaming the problems on gold instead. And then on top of that, Mo, the law of unintended consequences, like I said, when the government tries to stop gold imports, the silver imports are going up. This is something we say on a lot of podcasts. If the government tries to stop gold, silver, platinum, palladium, oil, mining stocks, these other things are going to go up. Government is not going to be able to stop people from putting their money and protecting themselves. And then one more factoid here about the massive imports in India that are going unreported. There is now very, very large amounts of gold tourism into Dubai. You have India's middle class and upper middle class and high net worth people flying into Dubai, buying humongous amounts of gold, putting it on, buying a seat for it on the plane, and flying it back.
Wow, I did not know that.
Yes. And the government hasn't done anything about it because the people are just revolting. They're figuring out a black market or an alternative, and this is just how free markets work. When, in Soviet Russia, when the people there, the citizens, when they wanted, American electronics and American jeans and the nice products and services that capitalism provides, there was a black market there, which was really actually the free market, and the people figured out how to get some of the things they wanted.
Right. And so,
Oh,
I'm sorry. So all these indicators that you just talked about should mean that gold and silver cannot stay at these prices forever, because the fundamentals are stronger than they ever were before, and so people should take advantage of these prices when they can. And so let's shift gears here, and I'm looking at the chart for the Dow Jones, and ever since Bernanke talked about pulling back on QE, the market had pulled back a little bit, but now it looks like it's about to break out again. So if you look at the chart, and for the Dow Jones, the next resistance is 15,500, and once it breaks that resistance, it has room to go up to 16,000. So the Federal Reserve, uh, what the Federal Reserve done, got the market going sideways, but look like the market's going to go back up again. And so traders out there should look out for that.
yeah, and this is all flight capital, like I said, Mo, leaving other markets that's scared and coming into the U.S. market, into large cap U.S. dividend, mostly dividend paying stocks. And then it's the Federal Reserve with the QE programs doing the wealth effect, wanting to boost up house prices, which is the largest asset that most middle class U.S. consumers own, is their house. So trying to intentionally boost up housing prices so people will have a higher home value and want to spend more money, and then boosting up people's stock prices so businesses will invest, banks will loan based on higher stock prices, and consumers will spend more money. What we're not seeing though, Mo, and this is why, as we've said on many podcasts here, this is just asset price inflation. This is not a real full fundamental bull market. Is yes, profit margins are high for a lot of these large cap dividend paying stocks, but a lot of it has been on cost cutting. Okay, they've cut humongous amount of costs. They've laid off a lot of their full-time workers. This is only going to continue going forward because of Obamacare and carbon taxes and all these other, and potential national sales tax, which is a value-added tax on internet purchases. Congress wants and Obama want to add all these things to businesses' costs, and this is not going to make it likely for job growth in every single industry. Now, there are certain industries like certain technology industries that will be adding a lot of job growth. There's job growth in the oil and gas industry thanks to the shale boom and the energy infrastructure necessary to put pipelines and other things in. But there is not going to be job growth across the board because of all these government tax policies and all these other policies that we're seeing here. Now, there are some factories that are moving out of Europe. Maybe China's losing some factories, but most of the factories are leaving Europe because Europe is even more of a basket case with higher taxes and higher energy prices, and it's coming here to lower tax U.S. states. But that's not enough to offset the jobs that have been lost, over the last 10 or 12 years.
That's a great point. And another factor that people should think about that could potentially slow down the economy. The price of oil has been going up a lot lately. It's over $100 per barrel, and we talked about the petro business cycle in our podcast many times in the past, and every time that the price of oil goes up, the economy starts to contract, and the Federal Reserve has to come in and roll out another QE program to get the economy stimulated again. So that's something listeners out there should watch out for.
Okay, another couple of points, Mo, on the stock market rising, which we think is going to keep rising. It's making higher lows and higher highs, but not really for fundamental reasons. We are not seeing, Mo, I think you'll probably agree with this, we're not seeing those small caps and those mid caps outperform the large caps, really. Maybe in a few sectors they are, but not across the board. And this is something we would be seeing in a real fundamental bull market because the small caps and the mid caps, the guys who can more efficiently grow their revenues, keep the higher margins, new technologies, those things, they would be leading the pack, and they're not really doing that at this stage. It's the large cap, high yield. The market is chasing yield. That's something very important for our listeners out there. If you find a good dividend stock, most likely the stock is trading at a very high PE ratio. You have utility stocks, you have large cap dividend stocks, consumer staples ones, that have little or no revenue growth, sometimes revenue growth under 2% revenue growth per year, trading at over 17 times forward earnings, sometimes 20 times forward earnings. So, and this is a lot of the earnings, Mo, have just been generated from these companies cutting costs and then taking that cheap debt that the artificially cheap debt that they're getting thanks to central bank policy, and they're going and buying back their stock to reduce their share count so they can massage their earnings higher.
And that's a great point there. And a lot of people are chasing the yield because they look at the bond yield and it's crap. They're not getting any return in the bond market. So now they're going in the stock market and looking at consumer staples and other industry that you just mentioned as well for better yield. And a lot of the yields out there are a lot better than what the Treasury bond provide right now.
Yes. On a relative basis, Mo, I do like all stocks better than bonds. Bonds and holding cash over the people should obviously have a liquidity and cash portion in their portfolio of at least 10% of their total net worth, just to take advantage of opportunities or an unexpected dip in a really good stock price or something like that. But you cannot hold lots and lots and lots of cash over the long term anymore. You just can't do it. You can hold bullion, but you can't hold dollars or euros or yen or British pounds or any of these other things, because all these guys running the central banks, China, Brazil, all these other guys are all Keynesians. And they see as the best solution, cutting interest rates and devaluing their currencies. And, even if they're not in the developed world, even if they're not in the G8, if they're in the G20, they're still on US dollar pegs. And that's going to create massive amount of inflation every time the country that they're pegged to starts to print.
And that's a great point. And we're starting to see a lot of other countries settle their trade in other currencies rather than dollars. I read an article the other day that Iran asked India to settle their trade in rupees rather than dollars. So we're seeing a trend here that a lot of people are moving away from a dollar for doing trade. And before this podcast, you told me about an interesting point that the former U.S. Treasury official, Dr. Paul Craig Robert, mentioned in the interview. So why don't you talk about that a little bit?
Sure. Well, let me put everything in context first. As we've tried to explain on many podcasts in the past and other interviews I've done for other investing websites, it's really the G20 versus the G8. So you have the developed world, the world that wrote Bretton Woods, for the most part. I believe Bretton Woods was, 1944? 43? 1944, I think, for Bretton Woods. You have that group that wrote that, who's retained most of the world financial power and, established the World Bank and the IMF and those things, versus the rest of the world, the developing world, the G20. And what the G20 has been doing now for the last 6 to 10 years has been trying to distance itself, to protect itself from some of the harsher policies of the World Bank and the IMF. They've been trying to set up their own, World Bank and IMF types of things with lower interest rate loans to developing countries. They've been trying to get a lot of their reserves. Almost all for listeners who are not familiar, the dollar is the world's reserve currency. What that means, and the dollar is also the petrodollar, so all commodities are priced in dollars, and people have to transact in dollars to buy commodities normally. And that means that a lot of countries that are running trade surpluses that are developing larger amounts of reserves, like China, et cetera, have to hold increasing amounts of dollars in their bank reserves. And they know that the U.S. has been inflating and these other countries have been running dollar pegs. So the U.S. has basically been able to export its inflation to China, to Brazil. That's why there's riots in Brazil, because Brazil is running a U.S. dollar peg and Brazil is tied to the dollar. And what is happening now is these countries want to trade in their own currencies, finalize trade in their own currencies, et cetera. The U.S. didn't seem to really care that much at one point, because the U.S. has the largest military, I guess. That's probably the main reason why, Mo, is the U.S. figured, we have the biggest guns, and people aren't really going to switch that much quickly. But now, behind the scenes, according to Dr. Craig Roberts, who used to work in the Treasury Department, according to his contacts, and I guess he has a lot of high contacts, in the U.S. government still and other central banks and treasuries all across the world, is that the U.S. now is worried that other countries will start to dump their dollars and treasuries faster and move their reserves to gold, because what you're seeing now is China and Russia and some of these other countries are starting to buy large amounts of gold. I believe China and Russia are buying over 50% of their trade surplus money each year now goes into gold. So the U.S. is worried about this, and the U.S. is trying to get trade deals now to support the dollar even further. So the petrodollar deal in the 70s, Mo, the dollar almost collapsed and hyperinflated before Paul Volcker came and saved the dollar, raised interest rates, did the right thing before the petrodollar was established. But now the dollar needs further agreements that people will hold dollars and create artificial demand for dollars so the U.S. can continue doing quantitative easing programs and continue exporting its inflation throughout the global supply chain.
And that makes perfect sense because the Federal Reserve already purchased 75% of the bonds out there. So I don't think they want to continue to raise that number up and hold 90 or 95% of the bond holding in the world.
Exactly, Mo. And if they have to purchase like 100% of every single debt note that the U.S. government or U.S. government agencies, because they're separate agency debt like Fannie and Freddie and all those other things, issue, then there's no way the U.S. can stop QE. It's just not mathematically possible. The math also, Mo, is that the Fed's talking about how once interest rates rise, we know it can't because maybe the market will revolt, maybe there will be bond vigilantes, but the Fed knows that if interest rates rise 1%, you're looking at another $150 billion a year. And that's right now. That's before the large principal of the debt continues to grow. Over $150 billion per year will be added to interest payments on the U.S. national debt that will have to be taken out of U.S. tax revenues that cannot be spent for other government spending programs.
So those are all the reasons why the Fed will not stop QE, and it has to print.
Well, the U.S. can't stop QE entirely, Mo, but what we might have, though, is a situation where the Fed tries a trial ballooning. They actually are brave enough to try a stress test or a trial balloon where they might try to take out $10 billion of the QE program, say reduce it down to $75 billion a month in purchases instead of $85 billion, but then the market would revolt. It would be like the baby, the screaming baby who didn't get his toy, the screaming baby who didn't get his favorite TV show on or his favorite treat or snack or something like that. It would throw a hissy fit. And the market would start to correct, 10, 15, 20% probably very, very quickly, and the Fed would probably then overreact back to the upside and maybe increase QE even larger than $85 billion a month, maybe to $100 billion then.
Right. Yeah, that is a one possible scenario that could happen. So let's shift gears here and talk about industry performance for the past few years. So I was able to research the best and worst performing industries in the stock market. And to no surprise, the number one best performing industry in the past 3 years has been U.S. travel and tourism, followed by U.S. home improvement, U.S. biotechnology, the U.S. pipeline index, U.S. recreational product, U.S. clothing, U.S. broadcasting, U.S. media index, U.S. consumer finance, and at number 10 is U.S. building materials. So mostly the consumer industry has performed really well the past 3 years, and we can thank the Federal Reserve for that because they're the one that wanted the economy to consume and spend money.
That's a good point, Mo. And a lot of it then, if it's Federal Reserve related, it's not a fundamental recovery. It's an artificial recovery. Because if the Fed actually allowed free market forces, there wouldn't have been a recovery.
Yep, I agree. And if you look at the 10 worst performing industries, I think people would can guess them because on my list, all of them or most of them are commodities industry. Number one, the U.S. coal index. Then we have the U.S. mining index. The U.S. gold mining index is number 3. The U.S. mortgage index is number 4. And then number 5 is the U.S. basic resources, aluminum, steel, U.S. industrial metals, and U.S. platinum and precious metal index. So mostly commodities have been the worst performing sector, and a lot of it is due to high rising production costs. And a lot of management out there are having a tough time dealing with that and not managing it correctly. And
also, Mo, a slowdown in China because the China housing bubble is artificial. That's not a free market policy to go build a whole bunch of buildings and stuff like that. That's a misallocation of capital and resources too.
Exactly.
Now, we found a study here. So let's talk about some things. We're more value investors. We're looking for undervalued growth stocks. Okay, we're looking
Yep.
for out of favor sectors where the fundamentals start to improve for a number of reasons, and then these companies within these sectors can go and grow their revenues, improve their profit margins, cut costs, and grow free cash flow and earnings that way. So let's talk about a study that I just found in the last month or so, and I'll quote the analyst here. It's hard to buy something down 80%, writes Mabane Faber, but it may not be a bad time to do just that. The average 3-year return, and this is based on empirical evidence since 1920, this is a lot of data, when buying a sector lower by 80% from a peak is 172% returns, according to his research. Think tech stocks in 2002, home builders in 2009, and junior gold miners today, which are off nearly that amount. The returns are similarly enticing for entire industries and countries, like buying Greece or other hated sectors and industries. And let's talk about then why these sectors, Mo, can bounce back and outperform over the long term.
Okay, well, if you follow the logic of how the stock market works, it makes perfect sense because when the industry goes in a downtrend and starts to bottom out, the companies start to tighten their inventory, they have layoffs, they cut their production, et cetera, and then the Wall Street analysts will start lowering their earning expectation, and then once their performance start to improve, they start easily beating the earnings, the Wall Street analyst earnings expectation, and then start to go back up higher and higher and higher, and the stock market and the stock prices will go up. So that study makes sense to me.
Exactly, Mo. And when these companies are in bad situations, and we'll use a few commodity examples here. We'll use the precious metal miners and the coal companies, and the U.S. natural gas companies. Coal and natural gas have been in a downturn, and along with uranium, for probably longer than any other commodity producer. And what these guys have done is it's forced consolidation. It's forced these guys to do more with less. They've cut their costs to the bone. They can't hold that much inventory. They're scared of taking on too much debt. And they're just focusing on their highest profit margin projects, and they're focusing on, rather than making long-term investments that might not cash flow for years, they're focusing on developing projects that are cash flow positive almost immediately. So these are important efficiency things. The Wall Street analyst downgrades are important for a value investor. You want to see those downgrades. You want to see stocks that are out of favor. You want to see the expectations bar for earnings and revenue and things like that. You want to see those drop a lot. And that's what we're seeing now in the commodity sector all across the board. We've seen it in base metals and other things for a while, coal and U.S. natural gas for a while. But we're starting to see it now in precious metals too, and I think that's a really good sign long term going forward. Let me name some other sectors where I still see a lot of value, and these industries are starting to actually improve a lot from a fundamental standpoint. These are out-of-favor sectors. The geothermal sector was a sector we talked about that Rick Rule and Marin Katusa were both in. They were in early. They were in it. Sprott was in it too. And they were in it 2 years ago when some of these geothermal stocks were worth $2 to $4 a share. These stocks have crashed more than 90%. And there's only a couple of them because there's been a lot of consolidation in the sector. And when those stocks were at $2 and $4 a share, they didn't have any earnings. They had no revenue increases, very little to no earnings. Now
they're overvalued.
Yes, and now, Mo, they're extremely undervalued. Sentiment levels are totally negative, but they have very growing cash flow and earnings. And yes, these stocks are more like utility stocks, so they do have a lot of capex and high debt levels. But the thing is, once the geothermal utilities are generating good cash flow, sometime in the next 2 or 3 years, they will start to pay a dividend. So for someone who's willing to wait a couple years, I think these are enormously good long-term value plays. The shipping industry, that industry is down 80 or 90%. That industry is consolidating a lot. They built a lot of new ships in 2007 through 2010, and these ships are more expensive, but they cost less to run, less energy costs, more efficient. They hold more cargo, they're faster, et cetera, et cetera. So yes, they're working through a supply glut on total ships, but all the old ships that were more expensive to run, and didn't hold as much cargo, those things will be phased out, and the better, more efficient ships will be used and bought for pennies by the smart companies that are thinking long term, and that industry, the global trade, will start getting back. Now, a lot of it is tied to China, but there is still a demand to move goods back and forth all over the world. One of the best commodity stocks besides precious metals I really, really like a lot at these levels, is the U.S. natural gas producers. Okay? Natural gas prices crashed because the entrepreneurs here in the United States, the shale revolution, horizontal drilling, hydraulic fracturing, yes, there are environmental problems. The water cleanup companies are good investments that can solve these problems. These problems don't have to be solved by government or the EPA. They can be solved by water cleanup entrepreneurs who can solve all of the problems. The question is, are these guys going to get the contracts to solve all the problems and clean up the water and get things back going again? But the U.S. natural gas producers, they are selling at abnormally low valuations, and some of these guys are starting to generate some earnings now. So we're not giving financial advice, guys, so we're just going to give our opinion. These are stocks like Chesapeake Energy, Devon Energy, Ultra Petroleum, and Exco. Those are the top four U.S. natural gas producer pure plays. Those guys are trading at extremely low valuations. Their reserves are being valued at little or nothing, and the natural gas price is bottom, all while the demand for natural gas globally, is starting to increase. You're seeing demand for LNG all over the world increase. Mexico is importing a humongous amount of natural gas from the United States. That is going to put a nice floor in the price of natural gas. Natural gas has bottomed and will slowly move higher, unless the economy completely collapses. But I think the central planners are going to be able to keep things in stagflation for a while. For-profit education stocks. These are like University of Phoenix, DeVry, those guys. When it was rumored that they wouldn't be able to take student loan money, the stocks crashed 95%. They're changing their business model and figuring out how to do that. They might have to lower their tuition prices, but they're for-profit, so they're going to run their firms more efficiently. Those guys are starting to recover now, and I think there's a lot of value besides commodities, some of the commodity stocks, in small-cap and mid-cap plays in a lot of sectors.
And yeah, I'm looking at the chart for natural gas, and it bottomed around $1 or $2, and it went all the way up at one point. It went $4.50 before going back down a little bit, and now it's at $3.64.
Exactly, Mo. And the one thing you brought up there, the $2 an ounce price, the only reason these guys were surviving at that price, they couldn't make any money producing natural gas. They had to hedge all their natural gas production, try to sell it forward at a higher price, which they're able to do for a little while, and then they're able to survive on selling more equity, diluting their shareholders to survive, and then also debt. So that's not sustainable. That's not a sustainable business model to produce something at a loss and then just dilute your shareholders. It cannot continue indefinitely, and that's why another reason for why I think gold and silver stocks, we may bottom bounce. I think we bottomed here in the gold and silver markets for a lot of reasons. We may bottom bounce for months or for up to 12 months, but if the price doesn't go a lot higher soon because the demand for the actual metals are increasing all over the globe, you're going to start to see a lot of supply coming offline. And the above-ground stockpiles for gold and silver, that argument doesn't hold a lot of water. If there was so much gold available for China and Russia and private investors, sovereign wealth funds, and other private investors, high-net-worth private investors to buy, seven-figure orders wouldn't be taking this long to fill. They wouldn't need Germany would be able to get its gold back immediately, and they wouldn't be raiding gold from GLD.
Exactly. And so to summarize what you just said, so we think the most undervalued industries are precious metals, specifically gold and silver, the natural gas industry, geothermal, the shipping industry. You mentioned certain profit education companies like Phoenix, and other certain small mid-cap stocks in other sectors as well.
Yeah, there's many small and mid-cap stocks that are really efficiently run right now, that are not being given any kind of good multiple for their revenue growth. The market right now, is paying a much higher multiple for safety, no revenue growth, and and a consistent yield or growing dividend yield or distribution yield if it's an MLP, than for small and mid caps that are actually can grow their business efficiently during tough times. And I think that's evidenced by the top performing sectors in the stock market, Mo, over the last couple of years have been healthcare, utilities, consumer staples, and master limited partnerships. Mostly the midstream fee-based business ones, not the commodity producer MLPs like Lynn Energy and those guys, because those things are having a nice pullback here. I think Lynn Energy and Vanguard. I don't think the SEC stuff is really accurate. These guys have been paying out distributions. Lynn Energy has, I believe, since 2003 and 2004. They've been growing their distributable cash flows, their revenues. They've been making good acquisitions. I don't think there's anything to their business that's saying that they're a Ponzi scheme and that they're fraudulent. They've been growing their top and bottom lines right. They've been paying out increasing distributions. They've been making smart acquisitions. I don't think that these are fraudulent business models. I just don't think the market thinks that these business models are sustainable, because Lynn Energy has really good energy traders at their firm besides just producing oil and natural gas and hedging their to lock in a profit. They also trade oil and natural gas options, and they make a lot of money doing it. And ExxonMobil and Chevron and those guys have a lot of energy traders, and they make large profits doing that too. So I don't think the market is acknowledging a good business model when I see one. Now, people should be careful. Obviously, don't go put a lot of money into Lynn Energy. But I think a lot of this SEC investigation, unfortunately, Mo, there is a high level of corruption in our financial markets, and I think a lot of expensive hedge funds who are high net worth were already short stocks like Lynn Energy, and then afterwards they went crying to the SEC and got the Barron's writer to publish that article as a hit piece to make sure they made many millions of dollars on the short side.
And that's a good point. And yeah, for anyone that wants a good yield, the MLPs are a good play as well. And so before we wrap up here, Jason, I believe you want to talk about other commodities before we sign off here. If you want to.
Yes. Well, let's just quickly go through a summary. I don't want to spend 20 minutes or 30 minutes talking about all these different commodities, but even if China is slowing down a lot, guys, okay? China is slowing down a lot, but there is still a certain amount of base level demand for all commodities, okay? So basically, if the copper price goes below $3 a pound, I'm not really interested in copper stocks or base metal stocks now. But if we have copper go below $3 a pound or even to $2.50, I would be very interested as a trade to start buying copper stocks, because that's not sustainable. In order to increase copper production, a lot of marginal copper deposits had to be brought online. Now, a lot of that demand was from artificial demand from China, but even at lower levels, there's still a certain amount of demand required. So the copper industry has had mining cost explosion, just like the gold and silver miners have. All miners have, for the most part, have had those cost increases. Even the oil and gas industry is having large cost increases for the most part, too. But coal, I think the coal industry is going through a real painful consolidation. The thing about coal is that, yes, it's hated and it causes a lot of pollution, but when the natural gas price rising and the natural gas price is much higher in Europe and Asia, those utilities in those countries will switch from natural gas back to coal at their power plants and start consuming more coal if the natural gas price goes too high too quickly. So those coal stocks might be interesting trades. I don't think they can go much lower, because they're really going to go – all of them are going to go bankrupt if the coal price goes any lower. The uranium sector is in very similar things. We said on our podcast, Mo, to start the year, I think John Manfreda said he thought 2013 would be good for uranium, and I said 2014 would be better because the megatons to megawatts ends at the end of this year, and then China doesn't start bringing more nuclear power plants online until 2014. So I think uranium, people have a chance to accumulate at these levels. I think 2014 will be really good for uranium. Oil, I really like the oil stocks. You can get awesome dividend yields in the large cap oil plays, like ConocoPhillips, Shell, BP.
Chevron.
Yeah, well, Chevron and ExxonMobil, Mo, have run up a lot. They're the most quality two companies best run out of the three largest, but their yields are nowhere near as large as like Total and some of those other plays. So I think there's value in that sector in general. There's really good small and medium cap oil plays too that have very good revenue growth, and the market's not pricing in anything right now. Companies that are going to be growing their revenues a lot, and the market's going to give them a really low multiple for it.
Right.
Platinum and palladium, that's a sector that we haven't talked about much on a podcast before. I don't think we addressed it that much. Those metals, almost all the production for platinum and palladium are from Russia, Zimbabwe, and South Africa, and there are huge geopolitical problems in all three countries for producing those. The grades are falling, and in a country like South Africa, the metals prices are down, and miners for every commodity are struggling, and the mining unions in South Africa want their wages doubled again. The miners can't afford it. They're going to go bankrupt. They can't afford it. Their business, they're already close, borderline closing down mines, cutting back on supply, et cetera, et cetera. There's just no way. So we're looking at humongous, supply deficits for platinum and palladium. I think people who just want to stockpile the metal are in good shape. There's really not many ways to play platinum and palladium with miners. A lot of the miners are in South Africa. I don't think those are good investments due to geopolitical risk. I really do. I think Stillwater, which is the largest platinum and palladium miner, I think outside of like the three major producing countries, Stillwater has had operational problems, but they're like the best house in a bad neighborhood. So Stillwater is an interesting play on dips. The rare earths, we said in our podcast that the rare earths would be good in 2013. We were early. I've been wrong on rare earths for a while. For full disclosure, I am out of my rare earth stocks, all of them. I've been out for over 6 months, including Great Western Minerals and Molycorp. But I think as early as Q4 2013, Molycorp may squeak out a tiny profit, and I think 2014 will finally be the year that the rare earth sector gets its act together based on producing value-added products and starting to supply some of the world's demand for heavy rare earths, which are needed for smartphones and these important electronics.
Yep. And that's the industry that had to cut back and tighten their inventory and cut back on production and do layoffs in order to manage the lower rare earth prices, like we saw in the natural gas industry.
Exactly, Mo. And the rare earths industry, unlike other industries, there's a lot of illegal mining where people don't care about the water, the soil, or if the people working at the mines die of asphyxiation or poisoning. And there is a lot of illegal mining and smuggling in and out of China to other countries of rare earths. So if that can be cut back, and I believe the Chinese government is starting to spend a lot of money over the last couple months. They were spending some money before, but they're starting to spend a lot of money now, cutting back on that, and they're consolidating the rare earths industry, and they're also cutting production too. There are a lot of Chinese rare earth miners who have started to cut production. So I think that is a good sign. The rare earths market hasn't fully bottomed yet, but a company like Molycorp, who is using advanced technology and new processes, Molycorp may still be able to eke out a profit that's a lower production cost than the Chinese miners. As early as Q4 2013, Molycorp is up 25%, I think, in this week alone, because I think the shorts started to cover, and they're starting to see the fundamentals improving in the sector. But I think 2014, going forward, will be very good for the rare earth miners. These guys were supposed to, and this is why I was so bullish on, one of the reasons why I was so bullish on the sector, they were supposed to be in production, obviously, a lot sooner than this. They were supposed to be in production, I think, last year. And they couldn't bring it online. The costs were a lot higher. These issues will get resolved, and these guys will start making really good money probably in 2014 and 2015. And then let's wrap up the podcast here, Mo, because I think we covered a lot of topics. But since we always cover, I also like large cap dividend tech stocks too. I think those are really undervalued and good dividend plays. I interviewed Vitaly Katsanelson earlier in the week. Our listeners out there, they can take a look at Microsoft, Oracle, Cisco. Those types of companies are going to pay consistent yields and be able to grow. Apple, forgot about Apple. So those are consistent companies that have a lot of products and services. They are generating good free cash flow. They're larger. Those are good value plays at these levels. And we'll wrap up the podcast then with our view of some precious metal stocks here and what we're starting to see. We are starting to see some M&A, though, Mo. It's small, but we are starting to see a growing amount of it.
Yeah, we're starting to see M&A. We're starting to see a lot of mining companies put out press release saying maintenance and care for some of their mining sites that they have.
Yeah,
Excuse me.
and these are quality companies too. These are
Yep, and also we're starting to see a lot of a few companies shut down their mines until the silver and gold prices recover, because if you look at the average cash cost for some of these mines, a lot of them, most of them are above 1,000. Somewhere, an average is between 12 to 1,300. I've read one article on Hine Capital, which is managed by Ben Davies, and they say that the average cash cost is over 1,700, and a lot of them today are operating at negative 30% margin, and that is not unsustainable. So I'm sorry, that's totally unsustainable.
Yeah,
so,
this cannot continue indefinitely, Mo. Even if the I think gold and silver have bottomed, we might test the lower end of the bottoming range here, maybe test 1,200 once more. But if we bottom bounce between 1,200 and 1,300, Mo, for even 6 months or 12 months, the miners cannot operate at a profit. They're going to have to close mines. Some of them may even go bankrupt or have to sell out for pennies on the dollar, and that could threaten to a supply shock because demand is still growing.
Yeah. So we're starting to see a lot of production shut off or cut down, a lot of layoffs. We're seeing a lot of layoffs, a lot of mining going into maintenance and care. And so that's going to be the trend for the next 6 months until the gold and silver prices recover. That's a good thing, because that's going to cause gold and silver prices to go up, because now the supply is going to be so tight. And if you factor in the high demand that's going on globally, there's no reason why gold and silver cannot go back up. I think it will go back up.
Exactly, Mel. And other countries are still running dollar pegs, and if this U.S. trade deal goes through, that the U.S. is trying to engineer behind the scenes, the U.S. is going to be able to do more QE without a lot of near-term ramifications. Other countries are going to import the inflation the U.S. creates. It's going to create asset price inflation, which, arguing against the Keynesian, asset price inflation is still inflation, okay? They refuse to acknowledge this. The Keynesians, the Wall Street robots, a lot of these guys, they refuse to acknowledge that higher stock prices, higher real estate prices is inflation. Okay? It is. Still inflation. Go read Genzo Parsons' Dying of Money. That's where the money normally goes first. It goes into the paper economy, into already existing assets, and it props up those asset prices. It moves them higher. So that's what we're starting to see now. I think the miners, I think we are at a bottom. We might bottom bounce, which is a trading range. A bottom bounce, guys, is a trading range. So we could be in either a tight trading range or a wide trading range for the gold price between 1,200 and 1,300. Or we might break out. I don't know. But unless the gold price goes back above 1,500, there are not miners who can produce these ounces and survive, because to find more ounces, besides the ones they're pulling out of the ground and replace them, it costs more than $1,500 an ounce to find new ounces of gold for growth capex, for exploration and development, and to grow production. So it's just not. This is not sustainable. This based on my research, and Mo and I do a lot of extensive research on this, basically daily. This will all be resolved in the next 12 months, no matter what, because these prices are not sustainable for the miners to survive. Do you have anything else to say, Mo, about the podcast here today?
No, that's pretty much a wrap up of what's been going on in the market, the commodities, and other sectors. The people should definitely tune in the next few weeks. We have a lot of good guests coming on. So that's pretty much it. Jason, thank you for your time.
Yes, thank you for your time. And our listeners, please like this podcast and share it with your friends. And go check out our Facebook fan page and follow us on Twitter.